We've all heard a lot of information about annuities, but we have an expert with us now, and that's Marcus Warren of Warren Wealth Management, and he's going to give you the pros and cons, the different types, and do they fit your retirement plan. Marcus, welcome in once again.
Thank you.
All right, you look fabulous, my man.
Appreciate it. Thought I'd add some color to this gloomy day, you know?
Yeah, you were saying you were coming in, man. It's coming down, isn't it?
Yeah, it is. It is.
Well, I'm glad you're here. Let's talk about making the rain fall, making some money happen for some folks here. Annuities. Everyone, we're being bombarded with information about annuities.
Yeah.
What is it about that, Marcus? Are they hot now? Some people are motivated, though, by selling annuities and making a commission, right?
Right. So, annuities, they can be a polarizing word. And, annuities are complex. They're often missold, and a lot of people don't understand it. That's why I felt that it's time to kind of clear, all the fog in regards to annuities.
All right, so what we're going to do is we're going to take each type of annuity. If you could do a little synopsis, explain them a little bit, a little bit of an elevator speech on each one of them, and then we'll decide if they're good, bad, or if they're right for you, I guess is the better answer here. So here we go. Let's go the immediate annuity. What is an immediate annuity?
What an immediate annuity is this? Well, actually, first I want to take a step back. So all of these annuities I'm going to talk about, all of them have three things in common. So all annuities have these three things in common. Number one, they are all issued by an insurance company. So they are an insurance product, all right? Number two is they all provide for tax-deferred growth. So as your annuity is growing, if it grows, you don't pay any taxes on it. You only pay when you cash it in or take any money out. And then lastly, they all can provide or have the option to provide income for life. Whether you utilize that feature or not, they all can provide income for life. So out of all the annuities I'm going to talk about, they all have those things in common. All right? So the immediate annuity. All right, so an immediate annuity is basically when you give a lump sum of money to an insurance company, and they immediately turn that into a stream of income. And you can take that income for life, or it can be for a period certain, meaning 15, 20, 25 years, however you want to receive it. And so the good thing about it is that people like that security. They like that mailbox money. In essence, you're almost creating a personal pension, if you will, and that helps. However, the only bad thing, or some of the negatives in regards to immediate annuities, is the fact that one is you give up control. So say you give a lump sum of a couple $100,000 to an annuity company and you want that income for life, but you die in year 2, that money's gone. You don't get that back, all right? Now, if you give a couple $100,000 to an annuity company, they turn it into a stream of income for life, and you live as long as Betty White, 137 years old, by the way, then you're probably coming out ahead. And so that's one of the negatives there. And then also, it doesn't adjust for inflation. So if you're getting $1,000 a month from an immediate annuity in 2021, it's going to be that same $1,000 a month in 2031, and we know it's probably not going to buy the same goods and services. So those are probably the negatives in regards to immediate annuities, but they can work and help out somebody's portfolio.
All right, maybe an immediate annuity is good for you, but perhaps you'd like to look at a fixed annuity. Okay, if you would, a little explanation there, if you would.
Okay, so a fixed annuity is when you give your money to an insurance company, and they basically are going to give you a fixed interest rate for a period of time, 1, 3 years, 5 years, 7 years, however long. And at the end of that term, you get your money back. So it kind of works like, I basically call fixed annuities kind of a tax-deferred CD. You give your money to the bank, they give you an interest rate, and then you get your money at the end of that, and you can re-up on that CD. Same with a fixed annuity. So it's pretty simple. That's the way it works. The only thing that I don't like about fixed annuities, and it's the same reason that I'm not a big fan of CDs or money markets or any fixed income investment right now, is that interest rates are just too low. They're just, you can't get a good rate of return on a fixed annuity right now. But it does provide that safety, and if you want some sort of interest rate for a period of time. So that's a fixed annuity.
But if you bought one perhaps 15 years ago, you had better interest rates, and maybe that looks smart at this point, right?
Yes, absolutely. Absolutely.
All right, let's go with the next one. That's a variable. I'm assuming a variable. Is that tied to the stock market?
Yes. So, all right, I'm going to take a step back in regards to variable annuity. So, I'm a fiduciary advisor, which basically means that I have to put my client's interest above my own. And because of that, I'm I call myself, I'm product or investment agnostic, meaning that I'm not partial to any specific investment, because a lot of times if you go see somebody who's focused on insurance, they're going to try to put you in an annuity, right? Take a square peg, try to fit it into a round hole. Conversely, if you're dealing with a broker or some sort of investment advisor, a lot of times they're just going to try to put you in the stock market, right? Being a fiduciary firm, we can do it all. So like I said, we just want to find out what our client needs to be and then develop a plan to get them there, whether that's annuities, stocks, bonds, mutual funds, gold, whatever it may be, silver, whatever it may be. We just want to help them hit their goals. So I'm product agnostic. Except for variable annuities. I am not a fan of variable annuities. And so what a variable annuity is, it's when you give your money to an insurance company and they are going to take that money and they basically invest it in the market. They invest it in mutual funds, but they call them sub-accounts, right? So number one, you can lose money because it's going to go up, it's going to go down. It's going to go up, it's going to go down. But that's not the main reason I'm not a big fan of these variable annuities. The main reason is because of the high fees. They are or can be riddled with fees. Fees as high as 6% each and every year. And these are things like M&E fee or mortality and expense fees, administrative fees, the money manager fees, the sub-account fees, rider fees. All of these fees add up and they can be upwards of 6%. And so let me give you an example. So let's say that a variable annuity has 3% fees. The very first year, the investment does well, it does 10%. Minus those 3% fees, you're left with 7%. Not too bad. But the very next year, let's say that it's down 10%. Now, they don't waive those fees when they have a bad year. They're still taking that 3% out, and so now you're down basically 13%. And so you have to do better than 13% just to get back to even, but you're not, because you still have those 3% fees that very next year. And so once you have a down year and those fees start to snowball, it's tough to gain any headwinds. And so with the high fees, the fact that you can lose money, the fact that they're complicated, and they're just often missold. I mean, other than that, they're fantastic investments.
Okay, we've got a minute here. Fixed index. Now, this is kind of hedging your bet, right? Is that what you're doing with the fixed index?
Yeah. So the way that these things are sold, it's basically like this. It's you know what, John? If I could get you an investment where you make money when the stock market goes up. You make money when the stock market goes up, but you don't lose when it goes down. You make money when it goes up, but you don't lose when it goes down. How would you feel about that? Wouldn't that be fantastic?
I like that, but you don't get the full if it goes up, right? You kind of agree upon a number.
Always a catch, and the catch is, number one, there's a time commitment. You're going to have to give your money up for a period of time. Some things last up. Some of these annuities last up to 20 years, but those aren't the ones that I'm a big fan of. And then, of course, they're going to cap your gains. So to fully protect you on the downside, they're going to cap what you can make on the upside. So since it's a fixed indexed annuity, it's tied to an index, and we'll just say the S&P 500, and they give you a cap of 7%, meaning that if the S&P 500 does 5%, you'll get 5%. If it does 7%, you'll get 7%. If the market does 16, 18, 25%, you are capped at that 7%. Now, conversely, if the market's down 20%, you don't lose anything. So you're giving up. To fully protect you on the downside, you're giving up that upside potential. So whether or not it works for you, that's up for the consumer to decide.
First 10 callers right now, you can tell this is good information. If you'd like an annuity analysis report, you can look at investment risks and the fees that you're going to be paying with your annuity. You can get it right now. Be one of the first 10 callers, 502-339-8255, 339-8255. He is Marcus Warren of Warren Wealth Management.